Anxiety hitting the real estate market. According to a new survey from data platform Dynata, 81% of Americans say it's hard to find a home to buy or rent right now, mostly because of high prices. Mortgage rates are a big part of that. They're rising at the fastest pace in decades. Home sales are suddenly slowing, and data shows new home construction in May declined more than analysts expected. So is housing in for the same kind of crash we saw in the Great Recession? Here's CNBC's real estate correspondent, Diana Olek.
During the Great Recession, when home prices positively crashed, millions of homes went into foreclosure. That was because the mortgages holding up the housing market were a mess. Lenders were basically giving anyone a loan. Not so since then. For the 53.5 million first lien home mortgages in America today, the average borrower credit score is a record high 751. It was below 700 back in 2010. And thanks to the recent run-up in home prices, those borrowers have record tappable home equity. That's how much you can take out of your home and still leave 20% equity in it. $11 trillion in total, up 34% from a year ago. That's a significant cushion in case home prices soften or even fall.
If the economy were to slow significantly, then we could potentially see a home price dips. But that's not my base case. My expectation is that we'll see home price grow.
During the Great Recession, 1 in 4 homeowners was underwater on their mortgage, meaning they owed more than the home was worth.
So when it comes to the financial position of homeowners in the aggregate, housing is on really solid footing right now.
So what about the riskier loans? Well, there are just 2.5 million adjustable rate mortgages outstanding today. Compare that to 13 million in 2007, just before the housing crash. A little more than half of those today are about to reset to higher rates, so there is a risk. But back in 2007, about 10 million of those were resetting higher. Mortgage delinquencies are now at a record low, just 3% of loans, which is actually less than before the pandemic. The real risk to housing right now is affordability and recession. Prices are still so high that some new buyers just can't get in, and sky-high rents make saving for a down payment very difficult. As for current homeowners, if a recession hits and people start to lose their jobs, then they may struggle to make their payments, especially if they stretch to buy that home in the first place.
Shepard Smith here. Thanks for watching CNBC on YouTube.